Hello, welcome back to the channel. In today's video we're going to look at clean energy and solar ETFs, how to invest without getting burnt. And this is also how to undertake a deep dive research on thematic ETFs. So the investment aim here is to participate in a major trend at a lower level of risk than backing a single company. Don't look for the needle, buy the haystack, as Jack Bogle said, but I would add, don't buy the whole barn, meaning I want to invest in the leading market companies, not hundreds and hundreds of companies in this area. And by choosing an ETF, ideally there's less effort to research, and company information is generally just propaganda where the ultimate source is the company itself. There's very little third-party reliable quality information out there, and bulletin boards are just echo chambers. If you invest in an ETF, one profit warning or one large director sale won't decimate your position. You're getting more diversification, and that's helping to manage the downside risk. And you're not constantly scanning for RNSs, that's the regulated news service, and you're not looking at prices every day either. And what you're saying is that in some point in the next 5 years, I can hopefully make a good return. So there are some problems with thematic ETFs, and I've covered this in a previous video. And here we have a chart of the healthcare sector, which is pretty good. We start at 0% and then it goes up to over 10% return in a year, and in a pretty tough year, so that's really good. If you go for a thematic ETF instead, such as healthcare innovation, then you're down at most over 30% and currently around about 15%. So there's a marked discrepancy between the theme and the sector. So thematic ETFs tend to be launched at a time of market euphoria. By the time you realize they exist, the smart people have already made their money, sold up, and moved on to the next big thing. And there's just too many clickbait articles about all this kind of thing. So thematic ETFs can create their own bubbles because they invest mainly in smaller companies, and the open-ended nature of an ETF can cause them to grow in size and become a major shareholder in these smaller companies, adding to the share price rise. So it's just feeding on itself, and you can see here where the graph goes nearly vertical. It's a complete mania around just one or two small cap clean energy companies. So if it seems too good to be true, it is too good to be true. And to quote Public Enemy, don't believe the hype. But what if it's different this time? And what if, I just can't resist, just for a little bit of my satellite portfolio, can't I just have something, and can't I just have a little look at this? So if you want to do that, here's what you do. You go to a website called justetf.com. From there you select equities, and then you select theme, and you select clean energy, and then you select the relevant columns to pull out ETFs that really have pretty poor results. So this is what I've done here. So fund size, 6-month return, 1-year return, and then the volatility, and then this return over risk for 1 year is quite a key metric. Now ideally I'd use a longer time frame, but most of these ETFs haven't been around that long, and you can see there's a whole raft of ones that have been launched fairly recently. So what I'm looking at is, the best ones include things like RAISE and inrg. So I'm going to have a look at these and try and find out what's going on and what might be the best ones for me to consider. It's also odd that this Invesco ETF has lost nearly 8% in a year, whereas something like the iShares Global Clean Energy has made 20%, and yet they're both clean energy. So what's going on? And it's really the result of tracking different indexes. So you need to go beyond just the key information documentation and really get into the indices behind it. So and also here, what we've got is what this Invesco fund actually invests in, and it looks like it's capping the holdings at 1%. It's got 124, so quite a lot of holdings, and these ones, well, yeah, they're just not, it just has the low exposure to the real superstars of the sector, and that just means that it's not really going to give you what you really want in terms of capturing the potential growth that's going on here. So this one, you might think, well, Nasdaq, that's pretty good. If I just want exposure to US companies, then maybe if I find things listed on a US exchange, then that'll be pretty cool. But the problem is that companies like NEO have these ADR shares that are listed in the US. So that means that they are on the Nasdaq as a secondary listing. So things aren't always what they seem, and you have to work out, well, do the constituents of the index actually fit the theme that I'm trying to look at here? So I've got Albemarle, I think that's to do with like lithium, and I've got some car manufacturers, and it just seems like, well, it's not really quite what I want. I want more things like Enphase Energy and Solar Edge. So what to look for? The devil is in the detail. You need to go beyond the KID, the key information document, and the fact sheet, and you need to research the index. And what you can do, this is just ETF, so we've got equity, we've got clean energy, as we said before, and then down here it says matching indices, and you just pull up the indices and you've got the names here. So this one is S&P Global Clean Energy, and that's the one that this INRG is tracking, this clean energy ETF. So what we can now do is let's have a look at the underlying index and pull out some key facts from it. So I want to look at how the index is weighting its constituents. So it could be based on market capitalization, could be equal weight, that means everyone's got an equal shot at winning. Could be based on the revenues that match the theme. There could be a cap, so it says, well, at the most it'll be 10%. The number of holdings, the percent concentration in the top 10 holdings, what countries are included, ESG filtering, well, here, yeah, it's fairly obvious there will be some. The rebalancing frequency, so that's how long it goes for without anyone actually looking at what's going on and putting it back into line. So the rebalancing frequency is generally 6 months, sometimes it's 3 months. The more often you rebalance, the more costs, more transaction costs the ETF will have, but hopefully it will mean less risk for you because it's more accurately capturing what's going on. So how is the theme defined? Are we looking just at, say, like solar manufacturing, or are we including things like installation companies of solar equipment? Does it look at liquidity considerations, which is just the value of shares openly traded? And then finally, some providers actually construct their own indices, which I don't really agree with, because they're just really making something up and then following it. And there's no checks and balances between an independent company coming up with an index and then an investment company coming up with the tracker. So for the iShares Global Clean Energy ETF, INRG, so it tracks this S&P Global Clean Energy Index. It's got all countries of the world in it, including China, aims to have 100 constituents, $3 million of shares traded daily, ideally, 25% or more revenue from clean energy, including utilities. It's got a float adjusted market cap weighting. So that's saying that there's a free float of the company, excluding things like shares that maybe directors hold. And then you multiply that by the exposure to clean energy in terms of revenue and percentage bands, and then you cap all of that at 8%. So it's a bit complicated, but it is quite good. There's ESG filtering, and it'll rebalance every 6 months. Next up, L&G Clean Energy ETF, RENG. This tracks the selective clean energy index, so not quite as well known as the S&P one. It excludes China and Hong Kong, which I like because I'm just worried about what the Chinese authorities are going to do next, and I'm not sure of China's ability to export this sort of technology into the US. There might be problems there because the US can get quite patriotic and want to promote its own companies. And it says it's companies that are actively involved in the value chain of the clean energy industry. It's got 63 constituents, $1 million of shares traded per day at least, equal weighting, and the less liquid companies have a bit of a cap on them, and it rebalances every 6 months. So this one is probably going to be less volatile than some of the others, but then probably lower returns, reflecting the equal weighting. Next up, Invesco Solar Energy ETF, ticker is RAISE, tracks the MAC Global Solar Energy Index, does include China and Hong Kong, 45 constituents, which is not bad for a theme. It's not too bad. 750k shares traded daily, a modified market cap weighting depending on the revenue exposure to solar, ESG filtering, and this one rebalances every 3 months. So although it's quite tight in terms of the holdings, it will rebalance quite frequently. So now we're going to compare the holdings of those 3 ETFs. So one of the major companies is Enphase Energy, and it's pretty high up in RAISE, then inrg, lower in reng because of the capping that's going on. Solar Edge is another good one. Doesn't seem to be here at all, and yeah, it's quite up in RAISE. First Solar, another good one, bit lower down in inrg, and again it's capped in reng. INRG has things like wind in there as well. It's got Consolidated Edison in, Energy de Portugal. So it's got some other things that not sure I really want. So I think RAISE is good for a real pure play, capturing some of these cutting edge solar companies. RENG is less volatility, and you can probably sleep more soundly at night with that one. And INRG is it's a broader theme really that one's capturing. So different things. It kind of really depends on your risk appetite and just what your preference is around capturing a theme. So in conclusion, I would say that new funds or smaller funds are best avoided in the thematic space unless you feel that the underlying index that they're tracking is really superior. Funds following the same theme can have different performance depending on how they define that theme, what they exclude, and the weighting methodology. And you've got to research the index as well as the ETF, and that's the only way to really understand what's truly going on. And the best performers will have the most concentrated portfolio, but then they'll also have the higher volatility. So as we saw on the Just ETF website, if you look at effectively the Sharpe ratio, the returns adjusted for risk, that's a good way of selecting an ETF. So if you've enjoyed the video, hit the like button, hit the subscribe, and I'll see you next week.